All right, well, we got the break that we had been kind of anticipating, expecting over the last little bit today, breaking through some important resistance level or support levels, I guess now, prior resistance levels, breaking through some other really important technical levels as well, filling in a very important gap. These are all things that we've been hitting on for the last so many days. It was a very quiet week last week because of the summer holiday and options expiration. A lot of gamma built up over that that came out, and the market picked up the volatility. So I'm going to break down today's move and how significant it was, what it means, what we can expect to see now going forward. I'm also going to break down what drove today's price action, how that compares to what we saw at the end of last week, what that means, and we're going to take a look at a trade idea of a stock that's kind of representative of what the entire market's doing here and how we can trade that. So let's go ahead and get started. Today is Monday, August the 22nd, 2022. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, before we get started, I invite you to subscribe to our YouTube channel with that icon or the subscribe button down below the video. Also, while you're down there, hit that thumbs up icon, like our video, comment on anything that stood out to you. Join our website at MarketScholars.com with that link right there. Follow me on Twitter for more content between the videos from day to day. And join our Market Outlook Facebook group that we've created. Also, if you're watching our video on our blog, as you check out these things over here on the right, come down to the bottom, click that heart. Look, we got 100 likes. It's awesome. Keep that up there. That opens up this tab. Hit that like button. Same thing here. Hit the thumbs up icon and like us here on Facebook as well. Again, the more you do that, that really helps us get our content out to all of our followers on those social media platforms. All right, well, let's start off taking a look at the S&P 500 like we always do. So obviously, it was a pretty significant down day today, to say the least. After falling below that 62% retracement line, back below it, right, of this intermediate run that we've been on, and getting to the 50%, that really important 50%. Everybody's been tweeting about that. We never go back to new lows if we get above that 50% line. Well, we got above it. Now we're easily back down below it, and we're back down below this important 23% level. It's 4,200. This 23% line of this post-COVID bullish rally that we had started to retrace back here in the end of April when we broke below it and stayed below it. And the idea was maybe we might be ending that retracement now, that long-term retracement, with this break above. But as I've been saying, this idea of this breakout above those really important resistance levels could be a fake out if we fill in that gap from August the 10th. And lo and behold, that's what we've done today. We've filled in that gap. Very bearish short-term sentiment. One of the most bearish short-term sentiment we've had since this bullish run started. The momentum line dipped into below the 5th percentile. Again, the lowest it's dipped. I mean, this is very, very bearish short-term sentiment, to say the very least. But you are still above the 30-day moving average by 1.5%. Remember, the trend doesn't change back to bearish until you break back below the minus 2.5% mark. And also, you're still in the upper reversal zone. Like, you've gotten out of the 90th percentile for the first time, and that was a very, very long run above the 90th percentile. But you're still in the upper reversal zone. So you've got dark green shading, and you have a green line. So that's hardly bearish from that perspective. Of course, that's not the only indicator. If you take a look at some of these other indicators, like the long-term chart here, we talked about this idea of getting a lower close. Well, not only are we getting a lower close, we're not getting an upper shadow, and we're getting a bearish candle. And the week's not over. Very well could bounce right up here and fill in a lot of today's range by the end of the week, and even that would still give you a lower close. So, we're essentially turning, we've been so bullish. You got above the 200, the 40-week exponential moving average, 200, a proxy in this case for a 200-day. You had the Hakinyashi closed significantly above it. Like, it only kind of dipped its toe above it there 2 weeks ago. It significantly got above it last week, and just like that in 1 week, not in 1 day, the Hakinyashi close, which is more significant than the regular weekly close, because the Hakinyashi close is the average of the open, the high, and the low, and the close for the week. So the regular close. So that's an average. That's a pretty significant level to drop that far already because of the gap, essentially, because your open and your high are that much lower because of the gap today. That now your average is that far down, already below the 40-week exponential moving average. So you can see how bearish that is. When you look at like some of these other oscillating charts, for example, like the DMI here, you can see the DMI, the positive indicator is still easily above 25, but now the negative is too. So just like that, we went from being extremely low, like we were down at 12 and a half, but we've doubled that in the last couple of days. We've really gone up pretty significantly, and again, back above the 25 line. That's big time bearishness there. When you look at the RSI and the CCI, you're not above 60 anymore. You are still in the upper half of the chart, so that's a good sign. Remember, we'd have to kind of break back down here, at least below 40, if not below 30, to re-engage a new bearish trend, especially coming off of a peak at 70. And you are below zero, but you're not below minus 100 yet. You're not into this negative area. So, it's definitely not bullish anymore, but it's not as bearish as we might think it is, just right off of, this looking at it, off the top of the cuff here. Looking at the Ichimoku cloud, we are below the 8-day, the 9-day average here. On that 9-day median price is what the green line is. But you are still above the blue, which is the 26-day median price. You're easily still above the cloud, and you actually still have a mature bullish trend because you're still above 5 barely, and you're still above 80. So, again, it kind of goes to show you how bullish we were when 2 days like the last 2 days we've gotten have only kind of just dented what was a really strong bullish trend. Has not really even come close to reversing it yet, at least in some cases. Of course, when you look at the three green arrow charts, you do have 2 red arrows now across the board. So you have no pink shading, no green shading, and no pink shading either. You have to have 3 red arrows to get the pink shading, which means you have to get below the moving average, which, remember, we're not there yet. When you look at the 2-line version, we are below the 17-day moving average, and getting close to dropping below the value area in the 1-year chart. The MACD is easily below its moving average and dropping. It's pretty significant bearish momentum. So things have changed, right? That's a bearish pattern there. There's bearish momentum on that. The whole, we are down here. If I were to change the, this indicator down at the bottom to how far below the 20-day hole we are. So the hole is turned red. The parabolic stars are up on top. You have a bearish candle. So you have all 3 bearish things on this chart. But if you take a look at how far below we are below this 3.5% mark, but let's go to where we are right now. You can see that it's not common for us to get this far below the 20-day hole when you are bullish. When you are, so you can see over here. When you are bearish, you can see that's kind of how that kind of signifies that we are on this bearish trend. And really, it's not very common. You notice when you get these red turns, this is the last day, June 9th, was pretty similar. We were barely turning red. We were below the 200-day hole at that time. But if you look down at the bottom, we were about 3.5% below the 20-day hole. But we are pretty significantly far below on June the 9th. So this is what the regular candle looked like on June the 9th right there. And this is what our candle looks like now. So it kind of gives you an idea of just how bearish we are. We've seen this kind of bearishness before. We haven't seen it over here on any of these other bearish turns. It never did. When it got below zero, when it got below the 20-day hole, we never did get below it significantly until this one. The Qs are even worse, right? The Qs got down to 4.88%, which I have marked there. Was earlier this morning. So here's the current one. You can again see just how common it is to get this bearish. We weren't even this bearish on June 9th on the Qs. We were over here on April the 6th. We were about 4.5% below on that day right there when we turned red and got our first big bearish candle after some transitions. Very similar pattern here. So you can see like this was a bearish turn. This wasn't just a a turn like this one over here where you dip your toe below the 20-day hold, but nothing significant. Yes, we are still very high up above the 200-day hold, but this is one of the bigger bearish candles that we've gotten in quite a while. This is the furthest that we've been from the 20-day hold in quite a while. Things are changing. If you look at the McClellan oscillator, here, we got down to minus 62. Here, let me go to SPY. We got down to minus 62 on the McClellan oscillator to kind of give you an idea. Like, again, this doesn't happen on a whim, right? So minus 62.4 essentially is where we got to. So there's where we're at. And again, you notice, you can see some of these really bearish times that we've been this low. Usually in the past during bullish moves, we get this low and it pretty much signals the end of the drop. This is only a one-day drop. So, and we're coming down from a peak that failed to get above 1,000 we talked about on Friday. And we're already rolling back over. So if this ends up setting the low point, we're going to feel really good about things. But if not, this is a bearish enough of a move to start a bearish leg lower, as you saw on the whole moving average there. When you look at the other thing too that kind of that's the other thing that stands out is, like, we talked about the potential of this being a runaway gap on Friday. It was kind of lacking a little bit in terms of the size of the gap and then how much we finished down. You generally like to finish 2% down or lower, and we generally like to have a bigger gap than barely under 1 standard deviation. Well, now we did get over 1 standard deviation, and now we did finish over 2%. When you look at the Qs, it's even worse, right? There's that gap, and we were well below 2%. So this, if Friday wasn't a runaway gap, then this one is like this, because again, you gapped down and you ran away from it. So now again, if you fill that in, it's not a runaway gap anymore. But as of right now, it's got the makings of a runaway gap based on how, nothing's 100% or 0% in technical analysis, but based off of how big the gap was, relatively speaking, which is what we look at on this other chart, right? Based on how big the gap was and based on how much we finished down, these two things combined increase the odds that this was, that this was a runaway gap, which is the beginning of a move. And it turns this potential breakaway gap that we've been talking about for the last week plus, about the idea that, if this narrative shifting breakaway gap, that commodities have peaked, that inflation's peaked, that commodities are softening, that yields aren't rising anymore, all that change in narrative has been thrown out the window now because we filled in that gap, and basically has turned it into a common gap. I wouldn't say an exhaustion gap because it took so long, but it's basically turned it into a common gap. And now, given this, high odds of being a runaway gap, which is, again, breakaways and runaways are the gaps that don't get filled in, at least not in a timely way. Right? They typically start intermediate moves. You're either breaking through a significant resistance level that might get retested briefly, but we never fill in the gap, or you start new intermediate moves. In this case, potentially starting a new intermediate run to the downside. Because what you can see, once you break 210, there's nothing down here to the downside. If you zoom out a little bit more to 90 days, there's this no volume. We moved up so far, so fast over here in July, and again over here in July, right before expiration. We moved up so far, so fast that we haven't built up a lot of volume in this area, and you can see that would be a runaway gap. This one actually would be a runaway gap here because you filled that one in a little bit. This on July 19th was your runaway gap that started this bullish intermediate run, and this very well could be the runaway gap that ends it, that starts a new bearish intermediate run back down to the downside. And remember, if this is indeed a bearish intermediate peak here, it would still be lower than the last intermediate peak, which was the end of March. So, this would be a progressively lower intermediate peaks. Now, it did get slightly above the 62% retracement, so that lowers the odds of getting to lower lows. But, again, not to 0%. So it is a lower high point, and you would expect that it would at least make it towards those lows. Of course, you'll get some pretty significant resistance down here at about 38.50 to 38.75 in that area. So that's what that gap looks like. So filling in that gap is a big deal here. We filled in this gap from the 12th, and then of course now this gap here, and you're at the point of control. You haven't filled it in all the way. There's still some left to go, which again suggests to me that there's still some left to go here on this move over the rest of potentially over the rest of this week. If you take a look at today's volume and range, remember how weak it was this past couple of weeks, especially on Friday. Well, today 74 million, so it was above average in the volume. The range was 4.83 points, but you have to include the gap, so 422 to 417. So you're looking at about another 5 points in range. So you add that, you're at 9.83 on the ATR and 74 million on the volume. So 9 points is well up here. So above the average, but not off the charts. If it was off the charts, then it's hard to really sustain that. So it's above the average, but not off the charts. 74 million is above the average, again, not off the charts. So when you get above average numbers that aren't like, 4 or 5 standard deviation washout moves, then those are the kind of moves that can be sustained. You can see a big move on the VIX today, getting back above 20. We got above 20 on Friday, but now easily back above 20, up to 24, finishing the day at 24, back above this 90% mark. So really important change and volatility there. And as I've been showing you before, this correlation chart with the VIX and VIX 3M, the VIX and VIX 3M, that was so bearish, right? This was so negatively bearish, so very uncommonly and so significantly negatively bearish on the correlation. Now you can see how fast it goes back up. And as we've been talking about for the last week or so, as we've noticed this, the expectation was that both the VVIX and the VIX would both rally back up. And we've seen that, right? The VVIX rallied back up to 94 today, and you can see the VIX rally back up. And again, you would expect that would continue to be the case as the VIX moves, starts to rally back up. Now, it typically does gap at options expiration. So we did see that today. You can see here you are back above the 17-day moving average for the first time in quite a while. You are above the 30-day moving average here even. So you've broken above 2 moving averages. So pretty significant change. And we'll see if we follow through with some pretty significant positive momentum and a negative MACD. So there's a good chance that we get a run up here on volatility up into this half. Well above the 200 and the 50-day moving averages, and probably into the high 20s and low 30s on this current run. Again, especially considering the negative correlation between the VIX and the VVIX and the negative ranges. Remember, the ranges here for the VIX and the VVIX were so low, and now it's going to get. Remember, it typically gets this low when it spikes, and we got this low without a spike, which means we really had significant volatility compression. Combine that with that negative correlation with the VVIX, that is a recipe. I mean, we've been talking about this volatility storm for the last week, and we talked about last week. It was kind of a last week of summer before school starts, kind of a week, not a lot of participation. We didn't expect that storm to produce last week. It was this week and into next week that we really needed to pay attention to any kind of tornado. And as of right now, you're starting to see some spinning clouds, right? This is some spinning clouds. It can still, excuse me, it can still avoid being a tornado, but you can see we've got the storm that typically produces them, and now we got the spinning clouds and that train. You can hear the train, the sound of a train rumbling. You're seeing the signs, and today was a big one. Lots of big moves that suggest that this little bullish run that we've had that I talked about on Friday was very much a short covering type move, that we didn't see a lot of that same bullishness in other risk asset classes, that now it looks like this short covering rally is over with, and we're already back down below some of the major resistance levels that we had broken above with that gap on there. So again, in my opinion, I had been leaning into this camp, that this was kind of a false breakout Of course, I mean, it was a significant breakout. It was very bullish. You know, we can't deny what the bullish signals that it produced typically leads to really good bullish moves. But you know, again, there was some cracks in that windshield, so to speak, and there was some signs that it wasn't all that it was cracked up to be, and there's a pretty good chance that it could be a fake out. And as of today, the odds of that fake out have just risen significantly. Not to 100%, because today might just be a one-day phenomenon. We might fill in today's gap tomorrow. But if we follow through on today's move like we did on some of these other days, like June the 9th that we talked about over here, or this other move was it April or March, when the other day that we got that significant change in the hull, right? If we get those similar kind of follow-throughs, then you can see we're going to be back below that resistance, and back moving our way back down into these levels, potentially getting back below this 30-day moving average by a significant amount. Now we're back to a new bearish leg lower, to where we at least retest those lows, if not get significantly lower, right? And especially the main one that we'd be watching for is that 200-day moving average, right? This 200-day moving average here. You can see we are back after getting that long upper shadow last week. We are back down below the 30-week moving average. Getting back below the 17 will be a significant change, especially with that MACD rolling over, the histogram rolling over, and stochastics peaking just a smidgen up there above the 80th percentile. Again, we've seen this play out before in March and April, and we're potentially seeing it play out again. And ultimately, getting to and through that 200-day moving average, 200-week moving average is what would get us going on a real bear market, not this, right? But a real bear market that exceeds the 200-week moving average and then some. Not even the COVID move, because you were back above it within 3 weeks. More like what we saw back in 2007 and 8, right there, where it got below it and stayed. And the same thing in 2000, 2002, where you got below it there and then stayed below it, the 200-week moving average, for a significant period of time. So what do you think? Do you agree with that? Are you leaning in that camp too? Are you thinking that this was, that we're actually still bullish, that today was just a oversold, overbought sell-off, that we're still bullish, and we're still heading higher towards the new highs by the end of the year? Let me know what you think in the comments section down below, especially with what charts you're looking at, that I didn't share with you today in this video, that would point you in that direction. All right, if you take a look at now what's driving the price action here, you can see the big decline from highs on the Qs and IWM, SPY, and at the same time, look at the dollar just really starting to spike up, real estate rolling over, everything dropping, including bonds and commodities rising. So let's go back. You remember the last 3 days of the week, I showed you on Friday how this narrative has changed. So we'll go back to the 17th when it all started, and you can see here, again, commodities are up. They were, let's see here, they started down this morning, but then rallied throughout the day today, even while stocks continue to decline. So commodities are up. The dollar is up strongly. 2.5% is a big move for 4 days. And then you can see you've got, just to kind of give you an idea of how big that move is over, again, just 4 days. So if I were to do a rate of change, 4-day rate of change here on UUP, currencies that don't move the same as stocks, right? You can see this is, we're up 2.38%, but basically 2.39%, 2.3868 in 4 days. There's only been a handful of other times. Obviously during COVID was another time. Here, let me zoom out so we can get a little bit more perspective. During COVID, earlier here in June, in mid-June, we had a strong run on the dollar. Even this rally on the dollar we never did get this kind of rally we just have gotten right now. And even if I were to go out really, not including this one because it was a gap down, so 1, 2, 3, 4, 5, 6, 7. If I were to do a 7-day rate of change here, so basically about a week and a half, essentially. Look at that move. This is one of the biggest 7-day rallies that we've seen. 3.6627. So, there it is. There's the rally. And again, COVID got higher because COVID we rallied 7.5%, so double this in a matter of 7 days. And obviously that's, when you have such a big risk off event, you're going to have a strong move on the dollar. You have to go back to 2015, at the very beginning of 2015, kind of a culmination of this bullish move we had since mid 2014, and then again one last hurrah there. But that was really it. I mean, it's tremendous move. And if you look at like the ATR right now for UUP, it's relatively high. Like go back out to 2015, so you can kind of see the difference here. 2015, you can see, right now the ATR is right about 0.21, which relative to the price is at 0.72%. Relative to the price. This isn't necessarily extremely high, but you can see how the volatility of the dollar has been getting, a lot bigger. If you go out to 2015 when we had these moves, the ATR was much bigger. It was up above 80%. So considering what the ATR is right now, the dollar is just killing these ranges. Like today's range of 0.19, but you have to include the gap here. So we close at 28.93, the low of 29.01, so you're adding in another 8 points, so you're just about 8 points on top of 0.97, 0.27. That just kind of, it doesn't sound like a lot, right? But when you look at it, that's a 28% above the average range. It's not huge, but it's significant enough to be significantly above average. So the dollar, needless to say, it doesn't seem like the dollar is moving up very much, but it is moving up significantly. The dollar broke parity today against the euro, so it's back down below 1, and I'm not sure if it gets back above it. You kind of made a run. This happens a lot, right? You make a run at a very important level, support or resistance. It fails, but it doesn't really bounce up to new highs or anything. In this case, after support, and then you make a run back down and you break it. And broke it significantly. Like we closed below the low point over here. So that's a pretty significant break to the downside. The dollar's really shifting. It's really, really oversold. It's not very common for the dollar to be this far below that 200-week moving average. This is significantly low. You have to go, just to go back all the way to the max available for the ETF. The times that we have been further below is in 2014 and 15. We made that big run down to 1, and remember that this 2015 they were they were still very accommodative with their policy. They avoided any kind of QT. They waited 2018 to do that, and they avoided doing any rate hikes until the end of 2015, and even then they only did one kind of token ceremonial rate hike there. They didn't really pick up the pace in 2016 when the dollar was about as strong as it was for that period. There wasn't much they could do anymore. Like I said, they try to wait to avoid QT until 2018, and the dollar really started to rise on that. The dollar is stronger than any of these other times. You come back to, so you had that period, you come back to 2000 or the late 90s, and again we got all the way down to 85 cents. Like I was on the kind of I had the idea that we would probably stay at parity and hit this 78% retracement level, but obviously it's looking like now that it's making a run down towards 85 again. In this case, at least down to 95, which is where the 162% retracement of this rally is. So the dollar's rallying to the upside. Commodities are continuing to rally to the upside. They're not breaking above that 50-day yet. They're not breaking above that 38% retracement yet. But they are above. You do have a bullish divergence on the MACD. The MACD is above its moving average and rising, and price is above its 17-day moving average for 3 consecutive days here. And trying to getting above the 50. The 8 and 17 are above the 30. And now they're trying to see, we're in the gap here. It's a matter of whether we break out of that gap or not. And then you look at yields, which is the third thing this year has been bearish for equities. And yields rallied up today, up above 3%. and the MACD still rising. The 8 and 17 have just barely crossed the 30, and price has gotten above this 23% retracement. So we have been retracing during the bullish run, this bullish 2 months on equities. The yields have been retracing off of that peak on June the 14th. And now, according to this, the retracement will be ending. Now, it's only 1 day. It's actually technically 2 days, but we're not, we can still easily come back down below that 23. So definitely leaning towards the idea that it's breaking through, but not quite there yet. And you can see, of course, from a risk appetite standpoint, Bitcoin still, after having broken down on Friday, along with ARK Investments, they're still breaking down. And that's, I've been showing you that as a reflection of the kind of far end of the risk appetite scale. ARK Investments here breaking below the 50, breaking back below this 23% retracement of this intermediate decline that we had, which is also the point of control. Again, this would be a very reflective of where we are in terms of risk appetite, like high-end risk appetite. So needless to say, the markets are moving, are showing bearish signs. I've shown you this chart too, the new highs and lows index. When you look at the new highs and new lows index, we're back below the moving average on this. We're back, we're below minus 200 on the new highs and new lows. These are significantly bearish numbers. We're not, like, we never did get above positive 100, and that's okay as long as we stay above the moving average. But once you break that moving average, you can see the skew index is also, flirting with getting back below its moving average and rolling over here on the MACD. You look at this index here, how many stocks are below the 250-day moving averages? It is low, but the average isn't low yet. You can see on other corrections, and especially in other bear markets, the average has gotten a lot lower than where we're at here. You can see the corrections have gotten basically below 80%. The 20-week average, every single one, 2011, 15, 16, 18, COVID, all gotten below 80%. We're not at below 80% yet. So we haven't been low enough for long enough to get that down to even market correction low point. And you can see in the bear market low, it dropped all the way down. Eventually dropped. It did drop below 80% on the correction low initially. Never did get back up. And then, of course, coming down to the bottom. So needless to say, there are a lot of stocks here. Sorry, let me close some of these. A lot of stocks that that are showing some. There are a lot of signs are showing some bearishness. If I update this, how many stocks are above their 50-day moving average? Getting above 90% was huge. Getting from being below 10 to being above 90 is a huge, huge thing. Getting back below this 70% level will be a sign that we're rolling back over. We did it in the end of March. We never did get above 50% in June. And then, of course, at the beginning of the year, we had fallen back below the 1 standard deviation. So getting back below this 1 standard deviation level, happens to be at 68% now for the past year, will be a significant change for that. In the past 5 years, 1 standard deviation is at nearly at 80%. And you can see on a longer term level how significant that is. We were above that. So it was a very, very good sign. And we're starting to work our way back down below it. So, getting below 70 in the next, by the end of the week, if we get below 70 by the end of the week, that will give us a good indication of just how bearish we actually are right now, and how much we are in the midst of reversing. See let's see here, the odds. Let me get to the FOMC odds for rate hikes. The yield spread is still negative, but even though it's starting to improve, but improving has not been a good thing. Remember, we peaked in March 29th and early April with an inverted yield curve. Once it started to rise back above zero, that's when stocks really started to come back down. So now the yield curve is starting to rise again. It's actually not a good thing. It wasn't then, and it hasn't been right now so far. Yields are rising back above 30%, and the odds of a 75 basis point hike are starting to inch up a little bit too, up to about 55%. They basically flip-flop from a day ago. But from a week ago, we were only at 40% for 75 basis point hike. Now we're at 55. So the odds of this hike are getting significantly more. For this 350, again, to get to this 325 to 350. So basically another 100 basis points of hikes over the next 3 meetings has pretty much maintained itself at these high 90 levels. It's this green one, which is 125 basis points of hikes between now and the end of the year. That's the one that still is above 60%. And so it's still a relatively high probability that either we get 75 at this meeting and then 25 and 25 after to finish it out, or you get 50 and 50 and 25 through over the next 3 meetings. That's what the green line is telling us. And again, anything above 60% is high probability. Anything above 80%, now you're pretty much baked in the cake. But getting above 60% is a higher probability, more higher than not, that we'll get there. And of course, a very low probability that we'll end up with 150 basis points by the time over the next 3 meetings. Let's take a look at the sector moves over the last 4 days, including today. So let's come down to the comparison chart, and you can see XLK, XLY really moving to the downside if I were to go to August. And then again, starting with this 4-day period where commodities rallied and the dollars rallied and yields have rallied, you can see the pressure it's putting on everything except for really energy. Energy is held up with the rise in commodities, and your safe haven areas are holding up too with smaller losses. But XLC is getting hammered, XLY is getting hammered, XLK all 4.75% or more, nearly 6% on XLY, over almost 6.5% on XLC. Again, over just a period of 4 days, and you can see going back to when this whole bullishness started here in mid-June. If I see what day it was exactly, looks like it was the 21st, coming off that 17th low point. So starting there with the 21st is when we really started to ramp up to the upside. You can see that we were so bullish in XLY and XLK, and utilities though have held up too, and now they're starting to ramp down. You can see XLC starting to ramp down too, and then of course going back year to date from this whole thing started after peaking on the 4th, from the time that we peaked all the way now down to the downside. They're all still down heavily year to date. 22% for XLY, 17% for XLK. Materials is down. Financials are down. Big double-digit numbers. Utilities are up 8%. Staples are flat, down 2%, and energy still showing a 34% gain year to date. So very important shift in this sector rotation, as these up here at the top are really breaking down. XLC more than the others. XLC is below its moving average. Everything else is kind of coming down to rising moving averages, but with significant breaks. So we'll see, if they're able to hold, or if XLC is kind of showing us a sign of what's to come. Let me show you quickly the main global, the main economies, the biggest economies out there in the ETFs that track their stocks. Look at Germany breaking hard down below its moving average. France and Italy also below their moving averages. You can see how everything's falling. China has been below its moving average. Korea, which is again a reflection of global economic growth expectations, really breaking hard below its moving average. So these, this is the biggest economy in Europe. This is the biggest. This is a global proxy for economic growth. They're all showing us what may be still forthcoming in U.S. equities with how bearish they've been over the last little bit. You can see if I were just to look at how EFA and EEM and SPY are doing, and let's put on like some of these U.S. equities too, are doing relative to a global ETF. You can see the shift. Like U.S. equities have really been moving up, and international equities have been moving to the downside on a long-term basis there. But as I do the daily, you can see the breakdown in the Qs, the breakdown in the small caps. And really EFA is still struggling. Your biggest momentum mover to the upside is emerging markets. Again, not a whole lot of relative strength yet, because relative strength is probably negative. Anything below 100 is negative relative strength. So not quite there yet, but you can see, it's starting to show some glimpses of opportunity here. Here's the symbol relative to VT, and it's been really, the relative strength is way down. It's been really underperforming. Here, let's look at it on this chart too, and you can see the RRG chart down at the bottom. Let me change this down here to VT. Have been so bearish, and U.S. equities have been so bullish But you can see we're getting higher lows progressively. The momentum has been bearish, and let's look at the daily here on like a 1-year chart. And here's a daily chart, and you can see the increase in momentum now and the rise in the relative strength to the tune that we might start to get a little bit of a jump higher here on a relative basis, even if it's still bearish on an absolute basis, a jump higher here on a relative basis as we bottom out. The other thing that we've been paying close attention to in terms of risk appetite is how the Qs perform relative to IWM. Let me come down here and just look at a daily chart. Here's our daily chart here, and you can see the big breakdown the Qs had today. Remember, this breaking down is not a good sign. Like, that's not a good for risk appetite. This, we have a market cap weighted indexes. The biggest companies lead the way higher, and the Qs have the biggest companies in the world, in the U.S. at least, a lot of the biggest companies in the world. And again, a breakdown. You're below the 8-week moving average, which is below the 17-week. The 30s cross below the 50. Like, things are breaking down. The long-term PPO is dropping. That's not necessarily the most bullish sign to see this relationship deteriorate. For our trade idea of the day, I wanted to take a look at MasterCard. So MasterCard is kind of a proxy too for how much money is passing through the system, consumer demand, and you can see like Visa too. Visa the same way. MasterCard really broke down. Its intermediate line still in the upper reversal zone, so that's why you don't have the light green shading, even though you do have a yellow line. So we close 1/3% below the 30-day moving average. Relatively bearish pattern on the market forecast chart. If you look at the weekly chart here, we had been in a death cross environment, even though we've been relatively sideways. Bearish candle this week with a red arrow and PPO starting to roll over. When you look at the how it's done relative with this MACD and stochastics, you can see we have been in a convergence mode. MACD below its moving average, but the price still rising slowly above the 200-day moving average. Well, today the stock closed below the 17, the 200, and the 30-day moving averages and the point of control. Now, there's still some volume in this area, but that's a pretty significant drop, going from a convergence mode over the past week and a half to now a divergence mode, where you can really start to pick up the bearish momentum. But then you have, again, it hasn't been sideways. It hasn't been, it's not necessarily a strong bearish pattern, and there's not a whole lot of potential. The negative is still below 20. The positive is below 20 as well. That's not necessarily the best sign for it. The RSI and the CCI are dropping out of bullish levels. CCI dropping to a pretty bearish level there. And then looking at the Ichimoku cloud, we're still above the cloud. And you actually still have a pretty strong intermediate strength trend up above 2 and above 65. So you are below the blue line. So you have the potential that we can just bounce right off of this to the upside. And then of course we're not trending. There's not a gap in volume down here, so there's not a whole lot of potential to the downside despite the bearish signal. So what I decided to do then is to do a bear call spread, but be a little bit more aggressive with it. Sell at the money, so it cut my risk in half of what I normally do, but then sell at the money and go for a little bit bigger return than normal. So normally for a 1% $1,000 risk, I'm usually shooting for about $300 plus, 300, 350-ish in that range. Well, here I'm going for a little bit more than that, but on about half the risk, a little bit less than half the risk, or more than half the risk, excuse me. So it's still pretty conservative. I'm not going for a big return, but I am really cutting the risk off by being a little bit more aggressive. And you can see the maximum gains easily inside of 1 standard deviation move. It doesn't have to drop very far. It just basically has to continue the move from today forward. So it has to just be lower than where we closed today. So it's either going to do that, or it's either we're going to bounce up here, or we're going to continue lower through this spot. And we'll know really, really quickly. And considering that I've got a, you typically in short verticals, we're willing to risk what we're trying to make. Because I'm trying to make a little bit more than what I'm risking, I can stay in as long as I want. I can take a maximum loss in this trade. Obviously, I probably won't, because if it starts to bounce back up, we don't need to stay in any longer. But that's the benefit of this kind of setup, is I can risk the whole thing because that's about how much I'm trying to make. Just a little bit more than my normal maximum gain on a short premium trade like this. But like I said, with half the risk, so it gives me a little bit more flexibility. All right, well, that does it for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forum. So open up any new thread. If any question or comments you have, reply to anybody else's thread, and let's keep this conversation going in between videos. As always, thank you very much for watching. Remember to subscribe to our YouTube channel. Hit that thumbs up icon. Comment on the video. Like us on Twitter and Facebook as well. Join our website at marketscholars.com. Have a great rest of your Monday night, everybody, and we'll see you all next time.